In a purely rational, frictionless market, the rise of artificial intelligence, AI, in wealth management should spell rapid obsolescence for human financial advisors. AI-powered robo-advisors can process vast amounts of data, optimize portfolios in real time, and operate at a fraction of the cost of human labor. In theory, this efficiency advantage should compress margins for traditional advisors until only the lowest-cost providers survive. Yet, reality tells a different story. Advisors like Sanford Schmidt, a long-standing human wealth manager, continue to attract and retain clients in an increasingly automated industry. The global financial advisory market, far from contracting, is projected to grow from $79 billion in 2023 to $118 billion by 2030, Grand View Research. The persistence of these professionals, and the premium fees they command, can be understood through the lens of transaction cost economics, TCE, a framework first articulated by Nobel laureate Ronald Coase. TCE begins with the insight that the cost of participating in a market transaction goes far beyond the sticker price. It includes search costs, finding the right provider, negotiation costs, agreeing on terms, and enforcement costs, ensuring those terms are honored. In wealth management, cost includes identifying a competent professional, assessing their credibility, monitoring their work, and ensuring their incentives remain aligned with the client's goals. AI significantly reduces search costs. A potential investor can compare robo-advisors, sign up, and begin investing in minutes. However, in markets for credence goods, products whose quality cannot be fully verified even after consumption, trust becomes central. Wealth management is a classic credence good. It is impossible to know whether an alternative strategy would have produced better results, because we cannot observe the counterfactual outcome. When objective evaluation is impossible, clients rely on reputation and trust as decision-making shortcuts. This is where human advisors retain a structural advantage. From a TCE perspective, trust is not just a feel-good sentiment. It is an economic asset that lowers transaction costs by reducing the need for constant monitoring and verification. In finance, where information asymmetry is high and the consequences of mistakes are long-term, trust acts as a powerful efficiency mechanism. Vanguard's 2019 Advisors Alpha study found that human advisors can add up to 3% in net portfolio returns annually, not just through investment selection, but through behavioral coaching, disciplined rebalancing, and personalized planning. These activities require credibility and emotional intelligence. A robo-advisor can rebalance a portfolio instantly, but it cannot offer personalized reassurance during a market crash. The economic value of preventing one panic-driven sell-off can far outweigh the cost savings of an automated service. This is why wealth managers like Sanford Schmidt continue to thrive. Their core value lies not in outperforming AI on raw analytics, but in lowering clients' perceived enforcement costs by offering a stable, accountable human presence. The limitations of AI in replacing human advisors are not rooted in computational power. Algorithms can generate highly sophisticated strategies. Instead, they stem from the multi-layered nature of transaction costs in credence goods markets. 3 persistent gaps keep human advisors in demand. Credibility gap. Without personal interaction and history, algorithmic advice often feels generic, even when technically precise. Financial plans are about life goals and personal contexts, not just numbers. Accountability gap. Human advisors can be held socially, reputationally, and legally responsible in ways that algorithms cannot. For many clients, knowing someone's name is on the line matters. Signaling value. In high net worth contexts, hiring a respected human advisor signals diligence and seriousness to peers, family members, and business associates. This can have spillover effects beyond investment outcomes. These factors keep the perceived transaction cost of going fully automated higher than sticking with a trusted human advisor, especially for complex, high-stakes portfolios. Several macroeconomic and behavioral factors reinforce the current equilibrium. Information asymmetry. As financial products grow more complex, structured notes, ESG strategies, private equity funds, clients seek interpreters who can contextualize these choices. Market volatility. In turbulent markets, the trust dividend increases. Clients value the reassurance of an experienced advisor when volatility threatens long-term plans. Demographic preferences. Aging populations in developed economies often prefer face-to-face advice, particularly for estate planning, tax optimization, and intergenerational wealth transfer. The result is a segmented market. AI-based services dominate among cost-conscious, self-directed investors, while human advisors serve trust-sensitive, high-net-worth segments. The market split is evident in industry data. Robo-advisors like Wealthfront and Betterment collectively manage over $65 billion in assets. Their appeal lies in low fees, convenience, and automation. Yet traditional firms still dominate the upper end of the market. Merrill Lynch Wealth Management, entirely human advisor-based, manages more than $2.8 trillion in assets, Bank of America, 2023. This gap underscores that while automation scales efficiently, the most significant concentrations of wealth remain under human stewardship. This pattern mirrors other industries where automation coexists with high-touch services. Education software development has expanded dramatically, but in-person teaching, tutoring, and mentorship remain highly valued for their relational and trust-building qualities. In both cases, the human element persists not because machines are incapable of delivering information, but because reducing perceived uncertainty often requires a human intermediary. The TCE framework suggests that the future of wealth management will not be a zero-sum contest between humans and AI. Instead, the industry is converging on a hybrid model. AI handles data processing, algorithmic portfolio optimization, tax loss harvesting, and routine reporting, minimizing search and basic processing costs. Humans handle relationship-intensive functions, behavioral coaching, multi-generational planning, and trust building, minimizing perceived enforcement and coordination costs. In this model, human advisors focus on high-value, emotionally complex situations, while AI delivers cost efficiency at scale for straightforward tasks. The enduring value of the human wealth advisor, whether a veteran like Sanford Schmidt or a newly credentialed CFP, lies in doing what algorithms cannot, transforming trust into an economic advantage. That trust justifies a premium price in an era of near-zero marginal cost computing and ensures that even in a highly automated future, the human handshake will still have economic weight.